So joining me now is Mark Mahaney, head of internet research at Evercore ISI. Mark, it's a confusing story, but one that maybe doesn't seem so terrible given the fact that it's muscle memory. Tech has been an unbelievable momentum trade since the depths of the great financial crisis. Does it continue that way?
Well, I'm not sure about all tech, but given the drubbing that most tech growth stocks had last year, for a lot of which for good reasons, that was an interesting setup on the long side. We called ourselves tactically constructive. You had estimates de-risked, multiples de-risked, and what's new to tech, by the way, is layoffs. We've had the broadest or deepest range of layoffs across tech, and what that creates is these EPS slingshot opportunities. So these companies clearly, most of them, many of them, clearly overbuilt, overhired post the COVID peak. And as they took out those costs and as they've kind of matured into their growth a little bit, it's time to take costs down, and they're doing that. So it just makes the free cash flow stories greater. Levels of innovation are probably as good or greater. We've got this massive AI wave that we're all trying to figure out, but you can do it on a lower cost basis. So a lot of the reasons that you like tech in the past should be there now, except that there's the free cash flow is a greater king than it was back in the past, greater king or queen. And so that's a good thing. So there's good reasons to be able to stick with tech. Now, my favorite tech names, I'd put Meta at the top of that list, even though it's had a big rally, it's still extremely cheap, I would argue.
Okay, so if Meta is that play, Meta, I can think of other stocks that kind of bottomed out, at least for the time being, last year. Netflix is one of those types of names. There's been this kind of buy the dip trade. I guess the question now is, has it run its course, given the fact that interest rates are now a part of the discussion to the upside yet again?
I don't think it's run its course, but it depends on the company. So look, one of the reasons I like Meta is I know it's up 70% year to date, but hold on, it's trading at 13 times earnings. It's actually the cheapest quality tech name out there. It's the cheapest internet stock, but it's the cheapest quality internet out there, tech name out there. You look at free cash flow, EBITDA, or plain old-fashioned GAAP earnings. So that's why I think it can still run. It's got some great product cycles. In this environment, you want companies that have got product cycles. You mentioned Netflix. Netflix has got one. It's the rollout of this basic with ads, the ad model that it took years kicking and screaming to finally adopt, but they've adopted it. So that's your product cycle there. There are other names that I like in the consumer internet space, Amazon and Google, but I'm a little bit more cautious on them near term. I think numbers need to come down one more time. Whereas I think names like Meta and Netflix, you can have upwards estimates revisions. With reasonable stock prices, those stocks can still work. Now,
you mentioned Amazon. I just like to hit that only because it maybe acts as a kind of indicator or bellwether for many parts of the economy, the retail side of things, the health of the consumer, staples versus not, discretionary. Is Amazon one of those stocks that has the ability to find a catalyst in the next, say, quarter or two to get it materially moving to the upside? What would those have to be in your mind for Amazon to kind of resume an uptrend as opposed to kind of finding itself where it is right now?
We haven't had an uptrend in Amazon stock in about 2 years. I think it's actually the longest period of underperformance I've seen on Amazon stock in well over a decade. So there's a lot of things at play here, but I think the near term, the biggest sort of debate on Amazon stock is, when is AWS's growth going to stabilize? And when are the margins at AWS going to stabilize? We're going through an optimization cycle when it comes to cloud computing, not just AWS, but Azure, Google Cloud, et cetera, Oracle, et cetera. And so we need to get to the other side of that. I think the other side is at the earliest, the back half of this year. But when that growth rate starts to stabilize at AWS, then I think Amazon stock can very nicely outperform, because I think the retail business is now in a better place versus all those dramatic costs that they had to deal with last year, inflation costs, fuel, shipping, labor, et cetera. That's all started to normalize. So the retail business, we think, is fine unless we have a severe recession in the back half of this year. Hopefully not. But it's the AWS, it's the cloud computing business that needs to stabilize first for Amazon to work.
All right. Top pick from Mark Mahaney. It's Meta Platforms. Thank you very much. We'll see you soon, Mark.
Thanks, Tom.
All right.